Welcome to Treasury One's market review, and the Rand is having a good June, managing to reverse May's losses and even made back a little bit more ground. It has now reached the point, though, where in absence of a fresh catalyst, the ZAR faces a tough task punching through the 18.20 to the dollar mark. It could enjoy a more consolidative trading session this week, that's barring any corrections in the US dollar. And speaking of which, markets will look to Fed Chairman Jerome Powell's semi-annual monetary policy report to the US Congress that's happening on Wednesday and Thursday. They'll be looking for clues on the central bank's outlook. Now, the Fed kept rates unchanged last week, but it sent hawkish signals of at least 2 possible hikes still to come this year. However, in the face of moderating inflation, ETM believes this sentiment should be taken with a pinch of salt. CPI data also out last week revealed inflation slowing in May from 4.9 to 4% year on year. Now, should this trajectory continue, there will be little reason for the Fed to bump rates as much as it's signaled in its dot plots. Over in the EU, the ECB hiked rates to a 22-year high, with the President Christine Lagarde adding that another hike in July is likely. Despite inflation slowing in May, Lagarde says it remains too high for the central bank to call for a pause and pivot just yet. Then in China, authorities are moving to provide policy support in the absence of a meaningful economic rebound following the prolonged pandemic lockdown. Chinese data, like last week's retail sales and industrial production, all continue to reflect the weaker economic climate, and now Cabinet has pledged to roll out additional stimulus measures in an effort to boost local demand to support recovery efforts. Looking to the week ahead, South Africa's CPI for May is scheduled for release on Wednesday. And although the worst of the inflation cycle is now behind us, a weaker rand, the high electricity tariffs and infrastructure failings, they are all driving a slower than expected fallback in inflation. Consensus expectations hold that headline inflation will slow from 6.8 to 6.4% year on year. The leading indicator is also scheduled for release on Tuesday, and the expectation is that it will continue to reflect the negative economic outlook. Then internationally, the UK will release its CPI data for May on Wednesday, with a slightly cooler figure anticipated. And that being said, though, price pressures are proving stickier than anticipated. So we're therefore expecting the central bank to further up rates by 25 basis points on Thursday. Then on Friday, the UK, along with the EU and the US, will also release PMI data for June, with a pullback in the figures expected in all 3 prints. That's due to tighter monetary conditions. That's then the week that was and the one to come for the markets.